Hello friends, in this lecture we are going to learn about financial regulators in India. Reserve Bank of India Establishment. The Reserve Bank of India was established on 1st April 1935 in accordance with the provisions of the Reserve Bank of India Act 1934. The central office of the Reserve Bank of India was initially established in Kolkata but was permanently moved to Mumbai in 1937. The central office is where the governor sits and where policies are formulated. Though originally privately owned, since nationalization in the year 1949, the Reserve Bank is fully owned by the Government of India. Now, preamble. The preamble of the Reserve Bank of India describes the basic functions of the Reserve Bank as to regulate the issue of banknotes and keeping the reserves with a view to securing monetary stability in India and generally to operate the currency and credit system of the country to its advantage, to have a modern monetary policy framework to meet the challenge of an increasingly complex economy, to maintain price stability while keeping in mind the objective of growth. So from preamble we have understood the basic functions of RBI. Now Central Board. The Reserve Bank's affairs are governed by a central board of directors. The board is appointed by the Government of India in keeping with the Reserve Bank of India Act and appointed or nominated for a period of 4 years. So the tenure of the appointment is 4 years. Now Constitution. There are two types of directors, official directors and non-official directors. In case of official directors, governor and not more than 4 deputy governors. So there should be one governor and maximum 4 deputy governors, and they all are full-time directors. And in case of non-official directors, they are nominated by the government, that is 10 directors from various fields and 2 government officials, and others include 4 directors, one each from 4 local boards. So this is the constitution of the Reserve Bank of India. So official directors and non-official directors. So the main functions of Reserve Bank of India. Number 1 is monetary authority. It formulates, implements and monitors the monetary policy and maintaining price stability while keeping in mind the objective of the growth. So this is the basic function of RBI. Now next one is regulator and supervisor of the financial system. It prescribes broad parameters of banking operations within which the country's banking and financial system functions. So now the objectives are to maintain public confidence in the system, protect depositors' interest and provide cost-effective banking services to the public. Next, manager of foreign exchange manages the Foreign Exchange Management Act 1999 or FEMA 1999. Now objective is to facilitate external trade, payment and promote orderly development and maintenance of foreign exchange market in India. Issuer of currency issues and exchanges or destroys currencies and coins not fit for circulation. The objective is to give the public adequate quantity of supplies of currency notes and coins and in good quality. Next one is developmental role. Performs a wide range of promotional functions to support national objectives. Regulator and supervisor of payment and settlement system. Introduces and upgrades safe and efficient modes of payment system in the country to meet the requirements of the public at large. Now the objectives are to maintain public confidence in payment and settlement system. Now what are the other related functions? That bankers to the government. They perform merchant banking function for the central and state government, also acts as their banker. So they are the bank for the government. Next one is banker to banks. Maintains banking accounts of all scheduled banks. So banks usually keep accounts with Reserve Bank of India. So they are the banker to the bank. It has 27 regional offices, most of them in state capitals, and 4 sub-offices. Now it has 6 training establishments, 3 namely Reserve Bank of India Academy or RBI Academy, College of Agricultural Banking and Reserve Bank of India Staff College are the part of RBI, and others are autonomous like Center for Advanced Financial Research and Learning, Indira Gandhi Institute for Development Research, Institute for Development and Research in Banking Technology. Now there are certain subsidiaries or fully owned subsidiaries of RBI like Deposit Insurance and Credit Guarantee Corporation of India, Bharatiya Reserve Bank Note Mudran Private Limited, Reserve Bank Information Technology Private Limited, Indian Financial Technology and Allied Services, and Reserve Bank Innovation Hub. So this is the basic concept of RBI we have understood, and next one is about Insurance Regulatory and Development Authority or IRDAI. The Insurance Regulatory and Development Authority of India or IRDAI is the apex body responsible for regulating and developing the insurance industry in India. It is an autonomous body. It was established by an Act of Parliament known as the Insurance Regulatory and Development Authority Act 1999. Hence it is a statutory body and year of formation is 1999. And the IRDA's headquarters is in Hyderabad in Telangana, but prior to 2001 it was headquartered in New Delhi. Now the functions of IRDA. Its primary purpose is to protect the rights of policyholders in India. It gives registration certificate to insurance companies in the country. It also engages in the renewal, modification, cancellation, etc. of the registration, and also creates regulation to protect policyholders' interest in India. So these are the basic functions of IRDA. Now the mission statement is like that: to protect the interest of policyholders, to regulate, promote and ensure orderly growth of the insurance industry and for matters connected therewith and incidental thereto. So basic function, basic objectives is to promote the interest of the policyholders and also to regulate the insurance industry. Okay, now next one is the Pension Fund Regulatory and Development Authority. The Government of India had in the year 1999 commissioned a national project titled Oasis. This is important. Oasis, that is for old age social and income security, to examine policy related old age income security in India. Based on the recommendations of the Oasis report, the Government of India introduced a new defined contribution pension system for the new entrants to the central or state government service except to armed force, replacing the existing system of defined benefit pension system. On 23rd August 2003, Interim Pension Fund Regulatory and Development Authority was established, that is IPFRDA. IPFRDA, not PFRDA, was established through a resolution by the Government of India to promote, develop and regulate the pension sector. So this is the basic developmental stages. So years are 1999, then 2003. Oasis in the year 1999, and then IPFRDA, that is in the year 2003, was established through a resolution by the Government of India to promote, develop and regulate pension sector in India. The contributory pension system was notified, that it is very important. The contributory pension system was notified by the Government of India on 22nd December 2003, now named as the National Pension System or NPS, with the effect from 1st January 2004. So NPS year is 2004. The NPS was subsequently extended to all citizens of the country with effect from 1st May 2009, including self-employed professionals and other unorganized sectors on a voluntary basis. So anyone can contribute to the pension scheme, it was extended in the year 2009, 1st May. So Pension Fund Regulatory and Development Authority Act was passed on 19 September 2013. that is a landmark development, and the same was notified on 1st February 2014. So PFRDA Act was passed on 19 September 2013 and the same was notified. Notification date is 1st February 2014. And now PFRDA regulating NPS subscribed by the employees of Government of India, state government, and by employees of private institutions, organizations and unorganized sectors. The PFRDA is ensuring the orderly growth and development of the pension market. So basically PFRDA's role is to ensure the orderly growth and development of the pension market. So what you have to remember here, that these years, the year of acts like 2003 for the Pension Regulatory and Development Authority Act was passed in this year, and then IPFRDA for 2003. Okay, NPS system was named in the year 2003. Okay, like that. And next one is the Securities and Exchange Board of India. SEBI is a statutory body established on April 12, 1992 in accordance with the provisions of the Securities and Exchange Board of India Act 1992. The basic functions of the Securities and Exchange Board of India is to protect the interests of investors in securities and to promote and regulate the securities market. So this is the different domain. Here SEBI has to take care of the investors in the securities market, and they have to develop and control, not only control, but they have to promote and regulate the securities market. Now let's talk about the background. Before SEBI came into existence, controller of capital issues was the regulatory authority, and it derived authority from the Capital Issues Control Act 1947. So this was the act before SEBI. This is very important. In April 1988, the SEBI was constituted as a regulator of the capital market in India under a resolution of the Government of India. Initially, SEBI was a non-statutory body without any statutory power. It became autonomous and given statutory power by the SEBI Act 1992. So this is very important here. So SEBI was constituted in the year 1988, but it was given statutory power and it became autonomous in the year 1992. The headquarters of SEBI is situated in Mumbai. The regional offices of SEBI are located in Ahmedabad, Kolkata, Chennai and Delhi. Now structure. SEBI board consists of a chairman and several other whole-time and part-time members. SEBI also appoints various committees whenever required to look into the pressing issues of that time. Further, a Securities Appellate Tribunal, that is called Securities Appellate Tribunal, has been constituted to protect the interests of entities that feel aggrieved by the SEBI's decision. Okay, so it was also constituted if anyone they feel that they are aggrieved by the SEBI's decision, they can appear to the Securities Appellate Tribunals, that is called SAT. SAT consists of presiding officer and two others. It has the same power as vested in the civil court. Further, if any person feels aggrieved by the SAT's decision or order, they can appeal to the Supreme Court. So first SEBI, then SAT, then Supreme Court. Okay. Now powers and functions of SEBI. Number one, SEBI is a quasi-legislative and quasi-judicial body which can draft resolutions, regulations, conduct inquiries, pass ruling and impose penalties. It functions to fulfill the requirements of three categories. There are three categories who are benefited by the SEBI. Number one, issuer, by providing a marketplace in which the issuer can increase their finance. Number two is investor, by ensuring safety and supply of precise and accurate information. Number three, intermediaries, by enabling a competitive professional market for intermediaries. So they are the beneficiaries of the SEBI. Okay, issuers, investors and intermediaries. By Securities Law Amendment Act 2014, SEBI is now able to regulate any money pooling scheme worth of rupees 100 crore or more and attach asset in case of non-compliance. SEBI chairman has the authority to order search and seizure operations. SEBI board can also seek information such as telephone call record data from any person or entities in response to any securities transactions being investigated by it. So SEBI performs the function of registration and regulation of the working of venture capital funds. That is also important. Okay, so SEBI performs the function of registration and regulation of working of venture capital funds and collective investment schemes, including mutual funds. Next, it also works for promoting and regulating self-regulatory organizations and prohibiting fraudulent and unfair trade practices relating to securities market. So that was all about SEBI. The basic concept, I think it has been cleared. Now the next one is Forward Markets Commission of India. The Forward Markets Commission or FMC is a regulatory body for the commodity market and future markets in India. It is a division of the Securities and Exchange Board of India, Ministry of Finance and Government of India. It was formed in the year 1953. It is headquartered in Mumbai, and this financial regulatory agency is overseen by the Ministry of Finance. That is very important. The Commission allows commodity trading in 22 exchanges in India, of which 6 are national. On 28th September 2015, the Forward Market Commission or FMC was merged with the Securities and Exchange Board of India or SEBI to make the regulation of commodity future market strong. So here what you have to remember, that year of formation, it was acquired by the SEBI in the year 2015, and also it is a division of Securities and Exchange Board of India, Ministry of Finance, Government of India. These points are important. Okay, now what are the functions of Forward Market Commissions? The functions of the Forward Market Commission are as follows. Number 1, to advise the central government in respect of the recognition or the withdrawal of recognition from any association or in respect of any other matter arising out of the Administration of Forward Contracts Regulation Act 1952, to keep forward market under observation and to take such action in relation to them as it may consider necessary in exercise of the powers assigned to it by or under this act, and to collect and whenever the Commission thinks it necessary to publish information regarding the trading conditions in respect of goods to which any of the provisions of the Act is made applicable, including information regarding supply, demand, price, and to submit to the central government periodical reports on the working of forward market relating to such goods, and to make recommendations generally with a view to improving the organization and working of the forward market, to undertake the inspection of the accounts and other documents of any recognized association or registered association or any member of such association whenever it is considered necessary. So it allows future trading in 23 fibers and manufacturers, 15 spices, 44 edible oils, 6 pulses, 4 energy products, single variables, and 20 metal futures and 33 other futures. So this is the basic concept of Forward Market Commission of India. I hope this basic concept should be clear from this one. Thank you.